Today's tape doesn't look promising. The more bullish headlines flood the market, the more uneasy I get. I'm bearish on US equities short term. This is the final bull trap ahead of big tech earnings season. I am not a perma bear though. My core takeaway is range bound choppiness, with the market swinging wildly between greed, and panic. Right now, stick to the playbook, delever, cut position sizes, and put hedges in place. Look at today's headlines. SK Hynix US listing and Micro's massive CapEx hike have sent semiconductor and memory sentiment through the roof. Meta roll out blockbuster updates one after another, and tech giants line up to launch new AI models. Morgan Stanley even pounded the table to buy the deep on Hynix. The top it all off. JP Morgan hung the South Korea flag on its headquarters building. What game is Wall Street playing with this coordinated hype? Memory stocks just got crushed days ago, yet they're pushing anyone to jump back in and chase highs. Let's rewind the timeline. Hynix was systematically sold off for 10 straight trading days before the IPO, and with an average of $6 billion fleeing South Korea daily, tonight's ADR guide price is set at 149. One ADR equals 1/10 of a local share, yet gray market hype has already pushed the price to 1,459. You can see exactly what they're scheming here. While the bubble bursting, deleveraging cycle fueled by Meta's news and Hynix IPO has temporarily paused. I warned you in my last video. Tonight will most likely kick off the final bull trap centered to Hynix listing. When am I this cautious? The prior sell-off fully exposed the market's fragile online structure, and semiconductors and memory remain the core speculative focus. The ultimate bellwether for US tech and South Korea's stock market perfectly mirrors the overall market sentiment lately. And trading activity in South Korea has gone completely abnormal. KOSPI's intraday swings this year have hit crisis level extremes. The index no longer trades like a broad, large cap benchmark. It's just pools of highly leveraged funds clashing back and forth between long and short sides. Year to date, KOSPI has crashed more than 5% in a single day at least 7 times, and with 2 sessions nearing or breaking a 10% drop. Such volatility on a major national index proves one thing: the entire trading infrastructure is out of control. Worse still, South Korea's VIX volatility index recently near 100, hitting an all-time record and surpassing peaks seen during the 2008 financial crisis and 2020 pandemic crash. And to put it simply, a VIX reading of 100 means capital prices in extreme swings for the next season, and some traders rush to buy bounces, others panic sell their holdings, and triggering massive cross-liquidation stampedes. Since 2026, South Korea's market has triggered multiple circuit breakers and trading hots. The circuit breaker system has run for over 2 decades, and yet half of all historical trading suspensions have happened this year alone. The root cause is clear: the market rallied too fast and got extremely crowded. All capital piled into Samsung and Hynix, while single stock leverage derivatives ballooned in size. And on the way up, returns get amplified. On the way down, selling pressure and fill multiply exponentially. And a routine 2% pullback quickly spirals into 5%, 8%, even 10% meltdowns under leverage liquidations. South Korean equities are trapped in a vicious feedback loop. Leverage magnifies price swings, swings lift volatility, and volatility forces funds to de-risk, and mass de-risking triggers deeper crashes. Eventually, nobody cares about intrinsic valuation anymore. Everyone only watches who will blow up first. Do you really think US stock is installed? Plenty of investors nearly got wiped out in a recent pullback. Let me share a striking set of data points to drive this home. The ratio between Nasdaq 100 VIX and S&P 500 VIX stands at 1.7 right now, a 23-year high, and a first break above 1.5 since 2018. And for context, the ratio only topped out at roughly 1.6 during the 2008 financial crisis. And current market pricing for tech downside fear is worse than the great financial crisis. Oddly enough, barely anyone in the options market is buying downside protection, and tech implies volatility sky high. Geopolitical risk like tensions around Iran and SPR releases linger in the small cap ETF. IWM's technical chart is flashing rear bear signals, but the market stays eerily complacent. This unhatched blind euphoria is the biggest red flag of all. Institutional midterm de-risking and distribution is an open secret, something I've covered dozens of times in past videos. The upcoming earnings season will put tech giants' capital expenditure plans under a microscope and bringing massive uncertainty. Institutions holding tens of billions in stock cannot dump shares during a panic sell-off. It would spark a liquidity crash and trap them at peak prices. The only viable exit strategy for large institutions is violently pump prices short-term and reignite retail greed and draw hesitant sideline capital in to absorb their shares. So to pull off this pump and distribute scheme, a market-wide sentiment catalyst is mandatory, and SK Hynix as the designated tool for this job. It serves two core functions: sentiment denominator and liquidity engine. First, sentiment anchor. The ADR is 7s oversubscribed, and handing retail traders an irresistible bull narrative and planning that this time is different mindset and erasing lingering panic. And second, liquidity engine. Nearly $200 billion lock-in and IPO subscriptions will be released back into the market, and paired with supply vacuums led by earlier leverage on wins in Korea, this creates perfect exit liquidity for institutions to offload positions at highs. Without Hynix IPO driving high, fresh capital won't step in, and institutions cannot liquidate their large holdings. The market is deeply split on US stock, especially memory stocks, split nearly 50-50 between bulls and bears, which is totally normal. Check my comment section. You will see frustrated bears, backholders, onlookers mocking the rally and endless sarcasm. Many followers ask me, will Hynix US listing mirror SpaceX IPO performance and surging at open, then crashing sharply, making chasing highs extremely risky? Straight talk. The two listings operate on entirely different fundamentals. Market expectations for Hynix IPO are fully present already, and once a bull catalyst becomes a universal sure win, consensus opening bell marks the peak of bullish sentiment and institutional mass profit taking. All alone buying power was exhausted pre-listing and leaving nothing but sell orders once trading begins. So I firmly believe Hynix can multiply its value long run, but it needs a full washout and bottoming process first. Honestly, call me unconventional, but I actually welcome this choppy market regime. A healthy secular bull market never moves straight up without pulse. It forms gradually through constant debate and share rotation and gradual expectation digestion. Sustained volatility redistributes share ownership, flush out short-term speculative leverage, and lets long-term industrial believers accumulate cheap positions. So has the long-term AI secular narrative changed? I don't think so, and that's a cure message I keep sharing to calm everyone's nerves. What shifted is the market cycle. We've left the era where loose storytelling drop rallies, entering a rigorous phase where firms must validate valuations with tangible earning results. This is exactly how a long-term structural bull market is supposed to behave. So don't get swept up into nice hype. Stay alert to short-term bull traps, keep deleveraging, and limit position sizes ahead of earnings. Once earnings trigger broad market repricing and leverage gets fully flushed out, we will go all in together. Let's get it, everyone, and have a great weekend. All views are my personal trading, not financial advice. Special thanks to ABC Financial Group for sponsoring the content.